All right, so we are in the middle of July and the deadline for individuals to file their income tax return is fast approaching. Now we understand that filing income tax return can be an overwhelming task. Now given the volume of information and tax jargons involved, the entire process may seem daunting. And so on the Money Show today, we will break down all the process that various aspect of this entire process. And for that, let's welcome on board Preeti Khurana, Chief Editor, ClearTax, and take this discussion forward. Hi Preeti, good evening and welcome to the show. So I think it's very important to get the basics clear over here, and the major confusion that usually viewers have or taxpayers have is about Form 26 AS and the AIS, where you have your entire financial information, your annual financial information listed. The importance of these two forms and how can one look at it?
As you very rightly said, that Form 26 AS and AIS are the most important forms that you require for your tax filing. Now, AIS is actually a very comprehensive statement. It has all the information that you need. It has, your interest income. It will have your TDS information. It will have if you earned any rental income, where the person who's a tenant in your property has been claiming HRA, then that rental income will appear in your AIS. So AIS is actually pretty comprehensive. You will see even your transactions with respect to sale purchase of mutual funds or equity shares will also appear in this form. Now, what the government has done from this particular tax filing is that all your tax payments, so whatever taxes you have paid, are also now only appearing in your annual information statement, which is your AIS. So earlier, these tax payments used to show up in Form 26 AS. That has now changed. And AIS is the form that you need actually for your tax filing. It has everything which is there in Form 26 AS. And what you can do is, since it's a pretty complicated, it's a large form, I would highly recommend taxpayers to use the pre-fill option. Now, you can use this on the income tax department website, or you can use it on ClearTax, or whatever online format you are using. What pre-fill will do is that it will pick up information from the AIS and populate your income tax return. Now, this is very, very important because you need to capture whatever is there in your AIS. So it could be related to any dividend income. Then you might have fixed deposit interest income. You may have savings account income. If you have earned any rental income, that is also likely to appear. Anything where a TDS or a TCS has been collected from you, all of that information will be available in your AIS. So if that form is bothering you, then use the pre-fill option. In case of Form 26 AS, I think that's kind of more relevant right now if you want to just sort of review on an ongoing basis, what are the various TDS deductions happening, what is the income related to it which has been earned. But essentially, what you will use this year will be your AIS.
So, Preeti, one very important aspect, as you also just highlighted, that one should know what's the right kind of form for them. So, talking about a salary class and also talking about someone who has income from maybe the virtual digital assets, cryptocurrencies or NFTs, freelancers or people, who have their own businesses or startups. What is the form layout for them, and how can they make sure that they don't end up filling the wrong form?
Absolutely. I think, that's a key question. And a lot of people get confused with these various ITR forms. So, before we talk about what each of these forms have, I think the easiest way would be to use an online platform where you don't need to choose the form. Based on the information entered by you, the form is automatically selected. So that's one way to take care of this scenario. The other thing is, a lot of people ask this question, that they have capital gains and they also have salaries. So do they need to file one form or two forms, and how do they report these various kinds of income? So essentially, you will file only one type of ITR form based on the type of income you have. Now, we can go one by one. Firstly, you have the ITR 1, which is applicable if you are resident in India for tax purposes. So residents can file ITR 1. The other conditions to be met are that your total income should be equal to or less than rupees 50 lakhs in the whole financial year 22-23. And also, you should own only one house property. That's when you can file ITR1. Of course, you can report interest income in it. It has a section for other sources. You can include that. Salary income, pension income, all of these can be included in ITR1. Now, if you are someone who is non-resident, or if you are director in a company, or if you have unlisted equity shares, your total income exceeds rupees 50 lakhs, or you have capital gains. In this scenario, you will only file ITR2. So ITR2 becomes applicable in these cases. Let's say you only have salary income, but the total income exceeds 50 lakhs, then you can't file ITR1. Then you have to go to ITR2. ITR3 is mostly for business income. Now, those who are filing ITR3 are able to report salary, capital gains, income from other sources, which is your interest income, fixed deposit interest income, rental income, capital gains, and your business or professional income in ITR3. So ITR3 is actually the most comprehensive form. It has all heads of income, and anybody with business income needs to file ITR3. Now, a lot of times you may have, incomes like intraday trading. Then also you can file ITR3. You have to file ITR3. As you spoke about income from selling cryptocurrencies or virtual digital assets, you can file ITR2 if you don't have business income. So if you just have income from cryptocurrencies, you have salary income, you can use ITR2. And ITR4 comes into the picture. It's also a specific form. It can only be filed if your total income is up to rupees 50 lakhs and you're using presumptive taxation. You are taking the benefit of presumptive taxation, which means you're using rates, that there's a special scheme for specified professions and businesses where if they meet the turnover threshold criteria, they're eligible to file a much simpler form, which is ITR4. But again, if your total income exceeds 50 lakhs, and you have business income, or even if you have capital gains or whatever, you can file ITR3. So don't get too bogged down by how to choose a form. Just use an online platform where they will automatically, based on what your various types of incomes are, they will at the back end choose the accurate form for you. Just make sure that you are filling all the fields accurately. I think that will be enough.
All right. Also, Preeti, what are the common mistakes that you've seen people making while filing their ITR? Ideally, it's better if you can go to a professional to get to do it, but a lot of time people want to do it on their own, and that also becomes a very cumbersome and a daunting task to do it yourself. But what would be the do's and don'ts that quickly you might just want to highlight to our viewers if you're doing it on your own?
Sure. I think a lot of people are now choosing to file their ITR on their own, and that's a good thing. It helps you understand how your tax return works. So I would just advise people to be careful about dividend income. If you hold any equity shares and you earn dividend income, it's probably sitting in your bank account, and you will be able to locate it through your bank account statement. So don't miss including dividend income. Just go through your bank statement. Include your savings account interest. If you have capital gains, then it's very important that you use an online platform, upload your capital gains details so that all your capital gains schedules can be accurately populated. SEBI had recently come out with a report saying that a lot of people who did futures and options were into losses. I think it was an overwhelming percentage, probably around 90% or so. If you are somebody who has had a loss either from a business or capital loss or loss from futures and options, you must file your return because you are able to claim set off. If you're not able to set off your losses in the same financial year, you're allowed to carry them forward. So make sure you report your losses as well. And AIS, whatever information is present there, make sure you go through it and ensure that you've included all of that in your tax return. Fill your bank account information accurately wherever you want to receive a refund. And yeah, I think those few checks will make sure that you filed an accurate return.
All right. Is there something as a nil ITR or a zero ITR also which people should know about?
Yeah, essentially, when you're filing a tax return and you don't pay any taxes, that's a nil ITR. Now, this might happen when you have income, but you've claimed deductions, you've claimed ATC, and your total income comes below the taxable limit, and you pay zero taxes. That's what people call nil ITR. Those who have foreign assets, so if you have any foreign asset or foreign income, even though that may be below the taxable limit, you are mandatorily required to file an income tax return. So even those returns may turn out to be nil tax returns, which means there is no tax due or tax to be paid as per those returns, but it might have certain disclosures with respect to your foreign assets. So please make sure, if you are someone who has foreign assets, you're filing your tax return. In case your income is below taxable limit, but certain TDS has been deducted, say, for example, you have fixed deposits or you have done certain investments where TDS comes into the picture, then you can claim a tax refund by filing an income tax return, and that has to be filed online. So file your tax return. If your income is below taxable limit and some TDS was deducted, you will be able to claim a refund of that. Yeah, I think those are the key things to keep in mind.
All right. So far, last question to you, Preeti. Any chances of the deadline getting extended?
I think this time, like last time, there's very little chance that the government will extend the timeline. Chartered accountants usually have to deal with multiple deadlines, and it's always good, when there is enough time. And the portal was up and running, when the filing began. So we are not looking at any extensions. So I would advise not to wait until the last minute. And recently, the released data around a significant number of tax returns have already been filed. So therefore, it would be advisable to not put this off until the last minute. You might have to, seek assistance, or you may be missing some information. So take some time out. The weekend is coming up, and file your tax returns.
All right, Preeti, I think that will be all. Thank you so much for being on the show today and helping our viewers with their ITR filing queries. Thank you. On that note, let's take a quick break, but then post that, let's figure out how to select a financial planner for yourself after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, managing finances is a very important part of our lives, and this is because not only do we need to maintain our regular expenses, we also need to plan our insurance needs, taxation matters, and also plan for our retirement. However, many of us tend to neglect our finances either because we do not have the proper knowledge or are hard pressed for time. Now, that is why it is very important to have a financial advisor who can sort out your financial life. And so on The Money Show today, let's understand how you can choose the right financial planner. For that, we have on board Shweta Jain, Investography. Shweta, good evening and welcome to the show. So we are going to guide people on how to select the right financial advisor for them, and these advisors are not finfluencers, by the way, that we are just talking about, Shweta. Okay, so Shweta, tell us what all does a financial advisor do for you?
Yeah, hi Kavita. Thank you for having me on the show. And yes, having a financial planner is really, really important. But we only realize this after we make mistakes, and sometimes the mistakes are too expensive for us to even cut down. So it's important for anybody and everybody, actually. People think that they would need financial advisors only when they have a lot of money. But I think you need a financial advisor to get you to that much money. So I think the idea is to help you go down a path that you see yourself going down with, and you choose a path rather than it, life taking you somewhere. I think a financial planner will help you set right your life, help you understand what is important to you. So it's not like a generic plan, it is focusing on your personal finances, because that's what we're talking about, right? So it helps you understand what is important to you, what is your money personality, what are your goals, how to have conversations with family about money. And I think it goes just deeper than selecting the schemes or stocks that you invest in. It's how to manage that money to maximize your life and make it a richer life.
All right, so there has to be a list of do's and don'ts, or maybe a list where you can identify the right kind of financial advisor for yourself, right? So what is the actual homework you as an investor need to do before you go to meet a financial planner, or maybe have a list of parameters set for yourself, basis on which you can decide whether this financial advisor works for you or not?
So there is a list, yes. Again, with each answer, you may see that you're either getting closer to that advisor or far away. So it starts off with qualifications. So what is the person's educational qualifications? Is he or she qualified to give you advice? So these are different from your legal requirements. This could mean NISM certifications. This could mean CFP certification. This could mean CFA. It could mean whatever else that they are doing to make sure that they are up to date in the field. It could also mean that they are continuously educating themselves. So it could mean attending regular conferences. What are they doing to upgrade their knowledge and their product information, their financial process as to what the world is doing today, where they are going, and how it is impacting them. So basically, being qualified to give you advice. Second would be their experience. So most people would not want a novice to give them advice. So make sure that you're going with somebody who has experience. It could mean 5 years plus, it could mean 10 years plus, whatever it is that works with you. Some people like having gray hair in their advisor. So I do have gray hair as well. So making sure that your expectation of the advisor in certain terms, even if it's sort of visual, right? So their experience would translate into good advice for you, because they would have had that many more different varied experiences, also experience with clients like you. Third would be testimonials from existing clients. So if they're able to provide, whether on their website, whether on their social media pages, or in person to you, there are clients who are happy to talk to new prospects or new investors and tell them who their advisor is, how they've helped them. So testimonials, references. So again, these are people who would refer customers, or the advisors themselves could refer to a few people and say, okay, these are my clients. You can talk to them in person or on the phone, or anyway. So the next point would be, I think the fifth point would be a team. How comfortable are you with a single advisor versus a multi-office, multi-brand ambassador advisor? So it would be how big of a team that you want working for you, right? Not saying either one is right or wrong. You have national distributors, you have national advisors. Make sure that the advisor you're going with, you are comfortable. Absolutely nothing wrong with going with somebody who is a one-man show or a one-woman show, if they're able to give you the advice and the experience that you deserve. Legally, what are the registrations that they work with? So if it's an distributor versus an advisor, if it's a financial advisor registered with SEBI, if it's a distributor who's working with products, charging you a fee or earning a commission from your products, as long as they have clarity of where the revenue is coming and they're clear about it and upfront and transparent about it with you, I think that's absolutely fine. So clarity and being transparent about their revenue is really important. What is their process? I think if they're able to explain that process to you, whether it's of choosing a scheme, whether it's their process of asset allocation, their process of financial planning, they should have that clarity and they should be able to communicate it to you. Their clarity of purpose. What kind of advisors
When
are
they
they?
are trying to communicate So Shweta, what happens is when they are trying to communicate us their plan for us, a lot of time, because you're an investor and because you're new to markets, new to the world of investments, you might not understand their language or the kind of plan they have for you. So it's very important for a financial planner advisor also to, you know, sort of gauge the understanding of investment that the particular investor has. And also a bigger question, because Shweta, we are talking about our hard-earned money, and how do we actually build the trust factor, you know, from whoever we are getting our financial advice or getting our portfolio investment, because this person is going to be there for all our financial goals. It is going to be a long-term relationship, and trust is something that builds over time, definitely. But what should be that first step towards, you know, at least to begin to start trusting your financial advisor?
So I think two things help build trust tremendously. One is ask the difficult questions. So ask them how they get their revenue, and ask them how they choose their schemes, how they work with funds. I think this will help you. The more transparent they are, the more trust they will be able to build in the relationship. And the second is definitely testimonials of existing clients. If you have come through somebody that you know, even better. So if there's a reference that's there, even better. So if you know somebody who has an advisor, the best way would be to ask them to refer. And even before you ask them to refer, ask them what is it about the advisor that they like, right? Because they've been working with an advisor, what has their experience been like? So a lot of times, because the advisor's language, like you said, these people, the new investors may not understand, because it may be more financial, it may be more technical, or investors may feel that you're dumbing it down for them. But having somebody who is an investor themselves would also help. So ask your friends, colleagues, who would they refer to, rather than going to an advisor and then asking them to give testimonials, because it may feel that, they are obviously going to share with their reference with somebody who only has good experience. You may not hear the bad thing, right? So you can actually ask your friends and colleagues, and that helps build tremendous value of trust. But on the other hand, the difficult questions, and sometimes asking them and even answering them would help you. If you look at an advisor and he's only going to give you flowery answers and say things like, okay, it's going to be a great journey, and not warn you about any dangers or any risks, I think that's a big red flag as well. So look for some of these red flags also.
All right, so let's move on. I think registration and the clarity of fees, that is something that investors should know, and it is something that should be declared even from the financial advisor themselves, right?
Absolutely. I think whether they're SEBI-registered, whether they're just AMFI-registered advisors and distributors, so this is a clarity that is absolutely needed, because your further expectations are going to be accordingly, right? So if they're an RIA, then the expectations would be that you're going to pay a fee, and that's how the process will sort of move forward, and you are going to be able to ask these questions. Versus if it's an MFT who's going to recommend schemes to you, then you make sure that you're checking on the cost of the schemes and making sure that you are getting products that you deserve, whether they're low cost products or whether the products suit you and your sort of requirements. So making sure that they are declaring their source of revenue to you upfront is really, really important. Their registrations is really important. So make sure that they're explaining to you and guiding you through the whole process, rather than you going on asking questions and only then getting answers. I think that's something else that you should look for, that the person, that the advisor is happy to share information and knowledge, whether it's through educational sessions, whether it's through one-on-one sessions, whether it's online, in person, whatever, that they are able to share these upfront before you asking them, because you will only ask them if you know about something. If you don't know, how are you going to ask the right questions as well? So make sure they are upfront with information and are ready to upgrade your knowledge as well. And if you have a question, they don't treat it as a doubt, but treat it as a genuine inquiry, rather than getting offended. I think them happy to clarify doubts would be another a good green flag for you to go ahead.
All right. Let's talk about finfluencers, and let's talk about finfluencers acting as financial advisors, which a lot of people prefer, obviously, because you get recommendation and a financial plan for free. But then everything that's coming free, especially when it's all about your hard-earned money, doesn't have to be trusted, and it doesn't have to be something that you would want to put your money on. So how do we figure out who is the genuine finfluencer and who's not, who's just trying to, make money out of your investments, which is not exactly helping you but helping them?
I think the best way to ask yourself the question is who's paying for this? If there's something free that you're getting, somebody is paying for it, right? So if you're not paying for it, somebody else is paying for it, whether it's the influencer themselves, which if they are, then what are they getting out of it? Which is why I think I stressed a lot on how an advisor's revenue comes as well. So that's a question that you should ask your influencer as well, saying who is paying for this, right? If the plan is free, before sharing information, because today I think before sharing any bit of information, it's really really important. Even as simple as sharing an OTP might cost you lakhs. So if you're sharing a lot of this personal information, trust me, it's going to cost you if this information is not staying confidential. So how safe and secure is this information that you're giving out to them for free, right? They are providing you a plan for free, but is this going to cost you in the future? Are the mistakes that you make, whether it's buying an insurance product which is long term, going to cost you in the future? Because, like I said, nothing is free, right? You're going to pay for it now, or you'll end up paying for it with mistakes in the future. So I think you have to ask these tough questions, and ideally I would stay away from anything that looks too good to be true. So whether it's a free financial plan or promised 15-20% returns or X amount, I would stay away from anything that looks too good to be true.
All right, Shweta, to sum it up, I think we've given a perfect list of how to identify or figure out the right kind of financial advisor for yourself. But then it's time to take a quick break, and post that, Shweta will be answering viewer queries and figuring out the right kind of financial portfolio for all our viewers. All this will happen after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Shweta Jain, Investography. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. All right, so let's move on. Let's take Nimisha's question, Shweta, and she's doing SIP in SBI Small Cap. Parag Parekh, we don't know which fund of Parag Parekh, but she's doing an SIP of 1,000 rupees in that, and she wants 1 crore in 15 years. Wants to know if this fund selection, these two funds are fine for her, good for her or not. We don't have her on the phone line, because we could have, try to get in more details, but then this is what we have so far.
So the schemes are good. It's a well-diversified portfolio. I'm assuming Parag Parekh would be Parag Parekh Flexi Cap, because that's one of the most popular funds. But I could be wrong. If it is the Flexi Cap fund, then it's quite diversified portfolio. She has started with 2,500, and that's a good amount to start off. Her target is as well there, so it's 1 crore. Who doesn't want to be a crorepati, right? So I think that's a good target as well. But she should set her other goals, whatever they may be, whether it's wedding, whether it's education, whether it's sabbatical, backpacking across Europe, whatever it may be, she should set up her goals. Funds are good, but to get to 1 crore, she would need to invest about 21,000 rupees per month. So as soon as she can get there, as she keeps increasing her monthly investments and get to this magic number, I think she should be good then.
All right, let's move on. Do I have Dr. Rajkumar on phone line with me? Okay, so let's just take his question. We don't have him on the phone line. And okay, exhausting portfolio, Shweta. So HDFC mid cap opportunities, Parag Parekh Flexi Cap, Quant Small Cap, Quant Infrastructure, Bandhan Sterling Value Fund, SBI Contra, PGIM Liquid Fund, Motilal Oswal Mid Cap Fund, Tata Digital India Fund, Mirasset Fang Plus NYSE ETF, and currently the investment value is somewhere around 60 lakhs. and he wants to convert this, or maybe the corpus that he wants to collect through this portfolio is 1.5 crores with 1 lakh investment every month. Okay,
So
Shweta.
the portfolio is extremely diversified. Sometimes that defeats the purpose as well, Kavita. So I would say relook at some of the thematic funds, so like infrastructure fund and the Digital India fund, because I do feel thematic funds need a correct entry and exit, and not always investors can get that right. I prefer the diversified portfolios just so they're lesser volatile and hence lesser action required from investors. HDFC Mid Cap is also a large fund, so 40,000 plus crores AUM. So I think that's something that he can relook at. PGM Liquid Fund, if there is a requirement or if it's an emergency fund, absolutely keep it. If he is trying to time the market, I would ask him to avoid doing that. Contra fund is something that will give returns in different kinds of time periods. So that's something that he may have to be a little more patient with. 2 years is a really a short time, but in 5 years, definitely he can get there. In 2 years, he is not going to reach his magic number of 1.5 crores, but in 5 years, he can definitely get there.
So, Shweta, one common thing that we saw in this portfolio, Dr. Rajkumar's portfolio, and also we've been seeing this in a lot of other investors' portfolio also that they send on the show. People try to buy the best performing funds, okay? And whichever category, if the fund is performing really well, they just want to dump it in their portfolio, and maybe that's also the reason why Dr. Rajendra had so many funds in his portfolio. A clear case of over diversification. Now, what are the disadvantages of being over diversified, Shweta? Having so many funds, will this increase my profit? Because if I'm doing a 1 lakh rupees investment, okay, every month in such a portfolio, what are the chances of my portfolio getting doubled before the actual time that I have actually counted for myself?
It's really difficult because see, an over diversified portfolio means that many more stocks would need to outperform the market rather than a focused portfolio or a correctly diversified portfolio, if I may say so, because um, here the base is much higher. So many funds would need to pull up your investment. So many stocks would need to pull up your investment. So a 5 scheme portfolio is what I foresee for 1 lakh here. And I think that would give him much better returns than a 10 scheme portfolio. Also, some of the funds in his portfolio look like he's just picked the best performing fund at that point, which means at a later point, it is going to underperform. Sooner or later, it is going to underperform. There have been time periods when one performing scheme or the top performer would actually be in the bottom 10 schemes the next year or the year after. So I don't want that to happen in people's portfolios. I'm not saying that you should look for the most underperformed scheme and put it there. It may be underperforming for a different variety of reasons rather than just stock underperformance. So I would recommend that you choose a portfolio that suits yourself and are well diversified, right? So it would mean that you have flexi cap, you have a little bit of mid cap, small cap, large cap, ideally passive fund. So it would give you a good diversification. I like the FANG NYC ETF also here because then that gives the international sort of exposure here. But do understand with international exposure, it means that it will underperform or could underperform the Indian businesses. So that is something that you should always keep in mind.
All right, let's move on. I think we have a caller on phone line with us, Krishna Teja from Hyderabad. Hi, Krishna Teja, how are you doing? Good evening.
Yeah, good evening, Kavita. I'm doing good.
Thank you so much.
How are you?
Thank you so much. I'm doing good. Thank you so much for sending us your query. And as far as the question that I can see is you want to know the best category fund to invest in the current market, and you are looking at investing 2 lakh lump sum. Can I know the investment time horizon?
No, it's not hurry. I can take 15 to 20 years. So it's for my retirement plan. So it's not, not in near future.
All right. So any specific goal that's lined up with this particular investment? Any particular corpus that you want to accumulate?
Yeah, my daughter is just 4, so for her higher studies,
Okay,
so I would
for
like
higher
to,
study.
yeah,
Okay, okay. So just to cross check if I've got that right, for higher education for your children, right?
right.
Okay, perfect. So let's figure this out, and we'll also tell you as per inflation, because education inflation moves faster than your general normal inflation, which is food inflation. So we will have Shweta get the calculation right for you also. So Shweta, it's very common when the market is really high, investors feel that they might be just missing the bus, and now is the time to put in the market just in case the market goes up further. So. For Krishna Teja and for all the investors who are thinking of investing at this market high and are preferring a lump sum way to invest, what should be the strategy?
So I like markets when they are a little low or correcting, because that's the time when you can actually buy. So it's like going on an Amazon sale or a Flipkart sale and buying stuff, right? When markets are high like this, it's actually making me nervous. And that's the time when most investors will come in, most new investors especially. But it's a great time to invest for them, because if their time horizon is 10, 15 years, I'm seeing it from the last 15 years, right? So, but for them from today, for the next 15 years, it's a great time to invest. So we should never forget that. So it's a good time. So for 2 lakhs lump sum, I would recommend that he do a systematic transfer plan. So what it is simple. He will first invest in a liquid fund. So for example, I would recommend a passive fund like a DSP Nifty 50 fund. So what he can do is put it in a DSP liquid fund and just start an STP, that is a systematic transfer plan, to DSP Nifty 50, which means an amount every month, instead of cutting from his bank, will go from his liquid fund. So it's just like an SIP, but it's sweeter because it is in the liquid fund, so you can't touch that money and you can't spend it. So say he moves 20,000 every month. So for the next 10 months, this money will move from DSP liquid to DSP Nifty 50, and he will get the benefit of staggering. If markets in the meanwhile were to correct, he will get that advantage and buy more units. And if it keeps moving up, that's fine. His portfolio value will keep going up. So he has a win-win kind of a situation. For 2 lakhs, I would recommend that if he's a new investor, he can do a DSP Nifty 50 only, or do an addition like a PPFAS FlexiCap, Parag Parik FlexiCap. If he wants a little bit of small cap, mid cap exposure, he can do Kotak Emerging Equity. But I think if he is a new investor, just keep it simple for now. Do it in one fund and not worry about it, because this one fund is still investing in 50 stocks. So he should not really worry about saying it's just one fund. I think sometimes investors, especially new investors, do worry about it. That it's just one scheme and they want to diversify that into 4 schemes or 5 schemes. I don't think he should do that.
All right, do I have Krishna Teja online with me? Krishna, do you want to ask anything?
Yeah, I'm not a new investor. I'm investing since 4 years. So I have index fund. I'm doing SIP in index funds and
You
two
already
lakhs
have
in that,
index funds. Oh, okay.
right.
So I
And
think, yeah, so these details were not actually given to us. Okay, so quickly, if you can just tell us the name of the funds that you already have in the portfolio.
yeah, Amitan S&P index fund. I'm doing 4,000 SIP, and I have
Okay.
a 2 lakhs of lump sum in Kotak small cap since 3 years.
Okay.
And I'm doing the ICICI Technology Fund 3,000 SIP since 2 years, 1.5 years.
Okay. All right.
And
So,
and and my
yeah.
wife also, I'm having similar type of portfolio. So as it's
All right, so
not
let's
to
just,
me,
because
so
I'm running out of time, Krishnaja, I'm so sorry, we did not have these details earlier. Shweta could have planned it really well, but then so far, whatever you've been able to gather, Shweta, quickly, what would you recommend?
Then I would tell him, if he already has a passive fund, then let's do a Kotak Emerging Equity and a combination of Parag Parik FlexiCap, because the schemes that he mentioned would not have a huge overlap with these funds, and this would also give him that international exposure that he didn't mention in his portfolio, and I'm hoping it isn't there, so this will give him that.
All the best, Krishna Teja. And with that, it's time to wrap up. Thank you so much, Shweta, for being on the show and helping our viewers with their financial portfolio queries today. And before I sign off, I'm going to leave you with our WhatsApp number and our email ID. And on the Money Show, we are also doing a tax classroom where we are trying to help you file your income tax returns. So any question related to that, do send us your queries on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.